Enjoying two AIs debating the markets every week? Like, share, subscribe, not for the algorithm, for your smarter self, every Sunday. This is the Weekly Market Podcast, zero fluff, just signal.
Okay, let's dive straight into this week's markets. We got a lot to unpack from the past few days globally.
Definitely. And our goal, as always, is to cut through some of that noise, yeah.
Exactly. Figure out what really moved the needle this week, and crucially, what you need to keep on your radar for the week ahead.
And it was, well, a pretty challenging week overall for markets, wouldn't you say?
It really was. It felt like volatility was back in a big way.
Yeah, the main triggers seem to be some surprising moves in the Treasury market, definite jitters there.
And then layered on top, fresh tariff threats popped up again.
Right. And those two factors really seem to reignite investor anxiety, putting pressure on stocks.
Even though, interestingly, we saw some signs that underlying business activity is actually, holding up okay.
But the bond market and trade worries just seem to overwhelm that resilience this week.
Let's start in the U.S. then, where a lot of this seemed to kick off. We saw a pretty sharp reversal, didn't we?
We did. Looking at the main indices, the S&P 500 finished down about 1.34%. The Nasdaq, the tech index, down 2.47%. And the Dow Jones lost around 2.21% for the week.
But the real standout for me, looking at these numbers, was the Russell 2000, small caps.
Oh, absolutely. That one really took a hit, down a huge 8.53%.
Wow, that's a big signal. What drove that specifically? A lot of it seemed tied to the bond market.
Yeah, a significant part stemmed from those bond jitters midweek. There was a notably weak auction for 20-year Treasury bonds.
Right, I saw that.
And that seemed to spook investors, sending yields higher quite quickly.
And the 30-year yield hitting 5% briefly. That's a big level.
It is. Its highest point since late 2023. That definitely got attention.
And does this tie back to the Moody's downgrade from the week before? And maybe wider debt concerns after the House passed Trump's tax bill?
I think those underlying anxieties definitely amplified the market's reaction to that weaker auction, yes. It added fuel to the fire, so to speak.
Okay, so you've got bond market stress building, then came the tariffs.
Exactly. Just as markets were trying to process the yield moves, we got news of President Trump proposing a hefty 50% tariff on some EU goods.
Effective June 1st, so very soon.
Very soon. And then also that specific threat of maybe a 25% tariff on iPhones.
Yeah, Apple shares dropped, 3% on Friday on that news?
That's right. So trade tensions clearly back on the table.
But here's the interesting conflict, right? Amidst all this negativity in the markets, the economic data wasn't all bad. The S&P Global Flash PMI
actually surprised to the upside. Both services and manufacturing activity showed a rebound in May.
Both hitting 52.3, I think. Better than expected.
Yeah, well above the 50 level that separates expansion from contraction, so a sign of underlying business resilience.
But housing was weaker. Or mixed.
Mixed is probably the right word. Existing home sales, they dropped in April. Lowest level for that month since 2009, really showing the bite of high mortgage rates. But surprisingly, new home sales actually ticked up a bit. So yeah, a bit of a confusing picture there.
So putting it all together for the U.S. this week, the main takeaway really seems to be
Treasury turbulence and trade threats. Those two just overwhelmed any positive signals from the business activity data. The negative drivers won out.
Okay, let's cross the Atlantic. Europe's recent run that came to an end?
It did. That modest rally streak finished. The SOX 600 index for the region fell about 0.75%.
And individual countries.
Right.
Germany's DAX?
DAX down 0.58%. France's CAC 40 dropped 1.93%. And Italy's FTSE MIBOR was down quite a bit, 2.90%.
So widespread declines. Was the UK an exception?
The FTSE 100 was, yes. It managed a small gain. We'll get to that.
Okay. So for the rest of Europe, what were the main drags? Those UF tariff threats again?
That was definitely a key factor, yes. The prospect of new barriers hitting European exports.
And weaker PMIs over there, too.
Yes. The Eurozone composite PMI actually slipped back below 50, down to 49.5.
So indicating contraction again.
Exactly. And apparently that weakness was particularly noticeable in France and Germany.
And this weak data fed into official forecasts, right? The European Commission cut its growth outlook.
They did, yeah. Cut the 2025 GDP forecast down to 0.9% from 1.3% previously.
And they specifically mentioned trade risks.
Explicitly cited rising global trade risks as a key factor in that downgrade. So it's clearly a major concern.
Makes sense. Was there any good news out of Europe?
Well, there was one positive surprise. Germany's Q1 GDP growth figure was revised sharply higher.
Oh, really?
Yeah, up to plus 0.4%, apparently driven by better consumer spending and trade within Germany itself.
Okay, a bit of a bright spot then.
A bright spot, yes, but perhaps overshadowed by the broader worries about trade and the softer PMI data across the region.
So the key takeaway for Europe is it's facing a tricky mix. Trade uncertainty, softer domestic demand.
Exactly, compounding what was already seen as quite fragile growth momentum, a difficult backdrop.
All right, let's turn to the UK then. As you said, the FTSE 100 bucked the trend, a small gain, 0.38%.
Correct. Held up relatively better.
But the economic signals coming out of the UK seemed really mixed, almost conflicted. Inflation looked hot.
It did. April CPI, the inflation measure, jumped to 3.5% year over year. That was definitely higher than economists expected.
What drove that?
Primarily rising utility bills and housing costs, according to the reports.
Okay, so high inflation, but at the same time, retail sales rebounded.
Yes, quite strongly, actually. Sales rose 1.2% month over month in April and were up 5% compared to a year ago.
So consumers are still spending despite higher costs. Interesting.
It is a bit of a puzzle. And adding to the mix, the PMI data was also split. Services activity edged up a little,
Okay.
but manufacturing saw a sharp contraction. So you have retail resilience, but industrial weakness and price pressures.
So for the UK, the story is retail strength is helping for now.
Right. But that sticky inflation and the softness in manufacturing definitely keep pressure on the overall outlook. Lots of uncertainty there.
Okay, let's head over to Asia, starting with Japan. Equities dipped there too.
Yes, the Nikkei 225 index was down 1.57% for the week, and the broader TPX index fell just 0.18%.
What was driving the weakness in Japan?
Two main things highlighted. Stronger than expected inflation figures and quite a significant surge in Japanese government bond yields.
Yields again.
Yields again. Both of these factors seem to have raised expectations that the Bank of Japan, the BOJ, might need to tighten monetary policy more or sooner than previously thought.
And the 10-year JGB yield, the government bond yield, hit 1.55%, highest since 2008.
That's a very significant move, yes. Highest in over 15 years. That definitely ripples through markets and changes thinking about BOJ policy.
And the inflation number itself, core CPI,
hit 3.5% year over year in April. Again, highest in over 2 years.
So fears of inflation becoming more embedded.
Exactly. That's the concern. Is this just temporary or is it becoming stickier, forcing the BOJ's hand?
But there was some positive data too, machinery orders.
Yes, one really standout positive number. Machinery orders spiked a huge 13% in March, apparently the strongest reading in almost 2 decades.
Wow, okay, so signs of business investment strength underneath.
It seems so. Another example of those conflicting signals we're seeing everywhere this week.
And the Japanese PMIs reflected that mix too.
They did. Manufacturing stayed in contraction while services growth slowed down a bit, possibly reflecting some of that global trade anxiety.
So the key message on Japan, rising inflation, is forcing the BOJ to rethink policy.
Just as these global trade frictions are reappearing, it adds another layer of complexity for them.
Makes sense. Okay, finally, let's talk China. Mixed picture there too, especially after some recent data.
Perhaps the most mixed picture of all, yes. The Shanghai Composite Index was down slightly, about 0.5%. The CSI 300 also down a touch.
But Hong Kong's Hang Seng was up.
Yeah, the Hang Seng actually managed a gain of 1.90%, so different directions there.
And this mixed data, does it keep expectations high for more government stimulus?
Very much so. That seems to be the consensus. We saw industrial production come in strong for April, up 6.1% year over year, beating forecasts.
So the production side is holding up.
Seems intact, yes. But on the other hand, retail sales slowed down more than expected, up 5.1% year over year, but that missed forecasts.
Suggesting maybe fragile consumer sentiment.
That's the interpretation, yes. Pointing to maybe some hesitancy among Chinese consumers.
And fixed asset investment, still dragged down by property.
Yeah, investment rose only 4%, and the reports specifically mentioned continued weakness in the property sector as a major drag.
So for China, the takeaway is production engine is okay, but the consumer story is weak.
Which likely means more pressure on Beijing to step in with further policy support or stimulus measures. That's what the market seems to be expecting.
Okay, that's a great wrap-up of a really turbulent week. Let's shift gears now and look ahead. What's coming up in the week of May 26th to May 30th that you really need to focus on?
It's another busy one for U.S. data. On Tuesday, we get the S&P Case-Shiller Home Price Index key housing data,
Right.
plus the Conference Board Consumer Confidence Index. Always important for gauging the consumer mood.
Okay, Tuesday housing and confidence, What about Wednesday?
Wednesday brings durable goods orders, gives us a read on business investment, and importantly, the minutes from the Fed's May meeting.
Ah, the Fed minutes.
Yeah,
Everyone will be parsing those for clues on policy direction.
absolutely. Then Thursday is packed again. The second estimate for Q1 GDP, weekly jobless claims, and pending home sale.
And Friday, that's the big one for inflation watchers, right?
Definitely. Friday, we get the Personal Consumption Expenditures, or PCE, price index for April.
The Fed's preferred inflation gauge?
Exactly. So its release is always a major market focus. We also get the final University of Michigan consumer sentiment reading that day.
Okay, busy week for U.S. data. What about elsewhere? Europe.
For Europe, the key things to watch will be any official reactions or responses to those U.S. tariff threats. Will we see retaliation, negotiation? Also, any revisions to those recent PMI numbers we discussed, and just generally listening for hints from ECB officials about their policy thinking.
And the U.K. Still watching inflation pass through.
Yeah, monitoring if that energy-driven spike in inflation starts feeding into other prices, and keeping an eye on industrial trends, any signs of improvement there.
Japan.
Japan has retail sales and labor market data out. Plus, the Bank of Japan releases a summary of opinions from its last meeting, which could offer more clues on their policy stance.
And China. Light calendar, but potential policy moves.
Exactly. The official data calendar is pretty light, but given the recent softness in retail and property, everyone's watching for potential policy action from Beijing.
So looking out for PBOC, liquidity measures, official commentary, that sort of thing.
Precisely. Any signals of stimulus or support will be closely watched.
All right, so with that calendar and the recent turbulence, what are the absolute top risks you think people should have on their radar for this coming week? Let's say top 5.
Okay, risk number 1 has to be tariff escalation with the EU.
Because that June 1st deadline for Trump's proposed 50% tariff is looming.
Exactly. It's effectively this coming Sunday. So the immediate risk is potential retaliation from the EU.
And the bigger risk there is?
A full-blown transatlantic trade dispute. That could really strain global supply chains, add inflationary pressure, and raise recession risks on both sides of the Atlantic.
So what should you watch? The EU's formal response, obviously.
Yes. And keep an eye on earnings guidance from companies in exposed sectors. Think autos, tech, luxury goods. They might start flagging concerns.
Okay. Risk number 1, tariffs. What's number 2?
Number 2, continued fallout from that 30-year Treasury yield spike.
Because breaching 5%, even briefly, sent shockwaves.
It did. It represents a real tightening of long-term borrowing costs, which impacts everything.
And the risk is that if yields stay elevated,
It could accelerate money flowing out of riskier assets like stocks, tighten financial conditions more broadly, making borrowing more expensive, and potentially cause stress in credit markets.
so watch upcoming Treasury auctions for demand.
Fed commentary on the yield moves and any signs of dislocation, particularly in high-yield or junk bonds.
Got it. Risk 3. Has to be inflation, right? That PCE number.
Absolutely. Risk number 3, a sticky or hot U.S. inflation read via the PCE index on Friday.
Because it's the Fed's favorite measure, and a bad number could really kill hopes for rate cuts later this year.
Precisely. The risk is that a higher-than-expected PCE print undermines that whole narrative around H2 rate cuts.
Which could mean
Potentially a stronger U.S. dollar again, and maybe a broader shift back towards risk-off sentiment in markets, where investors flee to safety. So Friday, May 30th, that April PCE data is critical.
Okay. Risk 4, something about the consumer.
Yes. Risk number 4, signs of consumer fragility, especially showing up in housing and confidence data.
We saw existing home sales drop. High mortgage rates are biting.
Exactly. The cracks are already visible, particularly in the housing market.
So the risk is that upcoming data like home prices or consumer confidence next week comes in soft.
Yes, suggesting the pressure is broadening beyond just housing and could signal a wider slowdown in consumer spending, which is, a huge driver of the U.S. economy.
So keep a close eye on those releases Tuesday, Thursday, and Friday.
Definitely.
And finally, risk number 5, China.
Risk number 5, the timing and sufficiency of China's policy response.
Because that mixed data strong production, weak consumption puts pressure on Beijing to act.
It really does. The market is expecting stimulus.
So the risk is if that stimulus is delayed or maybe not big enough.
Exactly. If the policy response is seen as too little, too late, it could dampen global growth momentum. Emerging markets and commodity prices, which often rely heavily on Chinese demand, could feel the pinch.
So what to watch there? Official comments, PBOC actions.
Any announcements on liquidity, lending targets, or maybe big infrastructure funding plans? Any signal of concrete action?
Okay, 5 key risks to watch. So pulling it all together from this week, it feels like markets are really caught in a tug-of-war, doesn't it?
That's a good way to put it. Caught between these powerful, conflicting forces.
On one side, you still got these signals of, underlying business activity holding up surprisingly well in some places, the PMIs, for instance.
Right. Resilience in the real economy. But then on the other side, you have these forces that are actively tightening financial conditions.
Like the sharply rising bond yields we've discussed.
The sudden return of significant tariff risks.
And inflation numbers that are just proving stickier than hoped.
Exactly. All putting the squeeze on.
So, looking at how things played out this week and what's coming up, it feels like this volatility, this push and pull, is likely to stick around, right? At least through the end of May.
I think that's the strong expectation, yes. Volatility is likely to persist.
Which leaves you, the listener, with a really fundamental question to chew on as you watch things unfold next week.
Yeah, how does this conflict resolve? You've got resilient business activity clashing with tightening financial conditions.
Which force ultimately wins out? Is it the underlying economic strength or the tightening grip of yields and risk factors?
And what could the answer mean for the path ahead for markets? Definitely something to keep front of mind as you watch the data roll in.
Okay.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.